My name is Fiona Okadia, and I am an economist at the Institute of Economic Affairs. And for today, I will be your moderator. So on behalf of the IEA team, I just want to thank you all for making time to be here. And then just a bit for those who are joining us for the first time. The IEA is an independent public policy think tank, and our mission is to be able to improve decision making in Kenya. So we do this through research, and we also have open dialogue and policy innovation. So our work spans through six broad categories. We have the public finance management team. We have the economic competition and regulation program. We have the popular economics and constitutional law and the economy. The fifth is trade and development, and the sixth is the futures studies. So the team that is hosting today's webinar is the Economic Regulation and Competition program, where myself and one of the presenters, Stephen Jairo, usually is in. So just to go into mobile money, we are aware that mobile money has indeed transformed Kenya's financial landscape. This is through broadening access. And so today we just want to look at aspects such as borrowers' protection, the digital credit practices that are in the country, and then just the adequacy of the laws and the regulations that we have concerning mobile money. So to help us unpack these issues, we have two speakers who will offer both from the regulatory perspective and also the legal perspective. So our first speaker will be Steve Jairo, who will come in and just outline for us the state of play. So just looking at, how the surge in digital lenders is shaping financial inclusion, probably what are the main drivers of mobile loans, the economic impact of this, expansion, and then he will just also address emerging concerns such as the aggressive debt collection tactics and borrower harassment, which I'm sure a lot of us are aware in terms of just how some of these lenders, not all, some of them go through certain means to be able to recover their money that has been deemed as harassment. And then the second speaker, Julu Okadia, will now come in and examine the legal framework, just governing the legal framework that is governing digital lending, looking at the rights and the obligations of both borrowers and lenders, and then the available redress mechanisms and the policy gaps that indeed still need attention. So together, they will tackle key questions such as, what protections do borrowers currently enjoy, and then also looking at where the loopholes are, and then what reforms are needed to balance innovation as well as with consumer justice. And I think with that introduction, probably just a few housekeeping rules. I would just like to let you know that this meeting is being recorded. So yeah, it's being recorded, and we will also share the recordings on our YouTube page, so that in case you want to go back and just listen in again, you can be able to do that. And then we also have a Q&A section. So in case during the presentation you have a question and you don't want to forget, because we'll have a Q&A session at the end, but you can be posting some of the questions that you will have, and then now during the plenary session we will just compile them and ask them. So you can, as you write, you can also specify to the specific presenter that you would like to ask your question to. So with that, it's my pleasure to invite our first speaker, Stephen Jairo. you're welcome to go on. Thank you.
Thanks, Fiona. So basically, with that background, I'll just give you the outline of the presentation I'm going to make now, which is just to look at the state of play in terms of access, usage, and quality of the financial inclusion models, the raft of them. Then we delve further into the main issue, which is why people resort to mobile money loans, and what are the issues therein. And of course, we'll finalize with some of the key takeaways. And just to note that this presentation was made available, and most of the information we'll be disseminating today has been got from this FinAccess household survey that was conducted at the end of last year, and some of the information also from the Central Bank of Kenya report of October 2024, as well as from the Kenya National Bureau of Statistics, the economic survey. So just to begin in terms of the state of play, according to the CBK report, there are very, very many digital lender applications that have been put through for licensing by the central bank, who is the regulator. Out of this 730, very massive number if you ask me, only 85 have been licensed. But that notwithstanding, there are instances where some players in the market are operating without the licensing. And reading some of the literature we have online is that they claim that they are in the process of actually adhering to the regulations. So they are actually some are allowed to operate as they in the process of adhering to the regulations and the laws of the land that regulate the area of digital lending. So that notwithstanding, it's important to note that the area of financial inclusion has both formal and informal. And just to look at the area of formal financial access, back in 2006, almost 10 years back, is that 10 years? No. 19 years back, it was at 26.7. In 2021, that increased to 83.7, and last year, from this report, financial inclusion has gone up to 84.8. And to cut that down, said out of every 100 people, only 16 or 13 are not able to access these forms of financial services. And in the same vein, it's important to note that of the financial of the forms of financial access available, and I talk about your microfinances, your SACCOs, your banks, and societies, then digital loans are the most common type of loans. Okay, and what has driven this in the past 2-3 years, from 2021 to 2024, 3 years, is the introduction of the Hustler Fund, which I think we all know about. The issues that we can tackle a bit later. Of course, the space for regulation of digital credit providers in the country currently is, by the central bank, definitely is a good one. There are a few regulatory barriers, and of course, the widespread use of mobile phones has eased or moved further the apex of users in terms of digital loans. And of course, with the mobile phone being accessible to virtually everyone in the country, there's that particular aspect of the ease of access that has now driven actually these numbers up, as we can see. So as I mentioned, we'll be looking at the state of play in terms of access, usage, as well as quality. So in terms of access, I found this interesting, is that in terms of the age brackets for inclusion, those in the age brackets of 18 to 25, so these are the guys who are probably just exited their high school, and those who are up to also between high school and the 4 years of campus, or 6, depending on the course you're undertaking one group, and those who are above 55 years. These are very interesting statistics in my view. Those are the ones that remain most excluded in accessing any form of financial services. Now, the reasons that have been brought out for this exclusion is the fact that some of these people don't have ID cards. Secondly, some of them, again, do not have mobile phones. Remember, this is the period between 2021 and 2024. And then, of course, these age brackets, mostly plus 5, are just nearing retirement, or some have retired at 50. So perhaps the income levels are a bit not able to access these services. And for those 18-25, perhaps they have not even gotten a job. They are in campus, so they don't have a source of income to actually be able to access a mobile phone, and therefore the raft of financial services that are available. So that's in terms of the age. Now, in terms of gender, this report states that a higher percentage of females access financial services and products through informal channels only compared to their male counterparts. Wow. And these informal channels are the so-called your chamas, your relatives, your friends, whereas the male counterpart is able to go to banks, microfinance institutions, and the like to access such services. And the reason mentioned for this, for that disparity, is that the females do not have collateral. That is one, and secondly, they may not have that financial literacy, and also that differential in male and female in terms of course, where the male feels like but the male is the head of the house, so perhaps they now try to suppress the female from trying to access this kind of financial services in different societal levels, mostly in the rural areas. Right, so but again, other than age and gender, in terms of access, we also have two other important aspects. That is education levels, and then and also access in terms of place of residence. So when you look at the education levels, financial inclusion in terms of education levels shows that those who have attained a tertiary level of education are more financially included, as opposed to those who have no formal education levels. Okay, so that the chart here shows clearly that. So up to about 75% of formal are included in the formal financial inclusion financial models. The 8.0 is informal, and the rest are the ones who are excluded. So not much of a difference between secondary and primary, but the disparity between the four levels is actually very glaring to see. The higher levels of tertiary education only have a 0.6% percent of persons not included in the formal financial or any form of financial inclusion models. Then when you look at the access in terms of place of stay, I think the numbers have been moving steadily, both in the right direction. So for those who are staying in the rural areas, you can see clearly that in terms of access of these formal and informal channels of financial inclusion, we have moved from 23% back in 2006, 10 years later in 2016 to 69%, and then last year to 80%. So only about 19% or so, 20, you can say 20% of those who live in rural areas are not able to access the formal and informal financial inclusion models. The same goes for the urban areas, which is much higher, even from the starting point, which was at 35 in 2006. 10 years later, it is 6%, that more than doubled. And then at 91.3, which is showing a bit of a slump by a 0.4 percentage points reduction for the 1 year period between 2021 and 2025, 3 year period. So that's where we stand in terms of access of these formal and informal financial inclusion models. Remember, this includes all the financial models plus mobile money access. Right. So to the second anchor of our presentation, which was on the state of play other than access. Now you look at the form of usage, and this is mostly on mobile money. Now, mobile money usage has risen up to 82.3%, as I'd mentioned in my starting slide. And this is largely driven by the expansion of services that are offered across board by the mobile money platform, digital, or so-called digital credit providers. Again, improved infrastructure buoyed by the developments on the technological front, and of course uptake, and then adoption of government services and e-commerce, which has been on the rise, I think, tremendous in the last 2 or so years, where also the government also seeks to offer not only services online, but remember the case of Hustler Fund, which actually rivals other digital credit service providers in the market. So other than that, the percentage of consumption from other lending institutions, so largely mobile money has taken the market by storm, but banks still command a 53% usage in terms of lending to user institutions. 31% for informal groups. I'd mentioned your chamas and your friends and relatives, the informal groups at 31%. And thirdly, the Hustler Fund commands about 29% of that particular market. Right. So other than usage, the third aspect of our presentation, so we looked at access, we looked at usage, then we now look at the quality. And when we look at quality, what we are trying to see is that do consumers have information? And in this aspect, I'm thinking about information asymmetry, information symmetry, where one is supposed to have information from both ends to be able to make an informed decision on whether or not to apply or partake of a given financial or digital loan service that is on offer. And this speaks to information on the cost of borrowing. So of course, therein you'll have your interest rates and the time frame that you need to return the loan within. And the loan default, which is an aspect that I think we'll need to, I'm sure my co-presenter will delve into it a little bit more with the regulatory environment and the laws of Kenya. And then the actions that are taken for repayment, which affect, all these three actually affect the quality of the digital credit service that consumers partake of. Right. So we looked at these three aspects, but digital loans or mobile money loans are here to stay. And then we asked ourselves, why do people resort to mobile money loans? And three issues come to mind instantly. So one, and this is mostly the key issue, is that it's a quick fix to urgent financial needs. Steven here doesn't have money to get some food, even lunch, maybe for by example, for today. Then what do I do? I go to my phone, I download an app, and so to say, by day, there are very many adverts if you are a user of these sites like YouTube. There are very many adverts of a variety, a host, a raft of digital credit providers or mobile money lending apps with diverse interest rates, offers, and you name it, it's all there. So I'll go in, find one that perhaps suits my pocket for at that time, take it up and be able to purchase food. So it's a quick way to get money, and it doesn't involve much things. Some of the users have been mentioned in this report. They also take these mobile money loans to actually pay their school fees for their kids or for themselves. Others take this to be able to settle their hospital bills, also to maybe expand their businesses. Some just for fun to get a system at home, a home theater. And one of the interesting things I also found out is that some also take digital loans to gamble. Believe it or not, it's actually happening. But that it is what it is. That's it. That's the matter we have to deal with. So it's a quick way to fix urgent financial needs. Secondly, digital loans or mobile money loans do not have bureaucratic documentation procedures like your banks, your SACCOs, your MFIs. You know, it's a matter of just most of them. They tell you they just need your name, your phone number, your identification. Some perhaps will ask you where you work. Some do not. How much you earn. Maybe some do not. It's app-based. It depends on the credit service provider, which you are with whom you want to take some loan. So some are straightforward. Once you issue your phone number, your ID, they can just take a look and then proceed. And the third issue that we thought actually makes people resort to these mobile money loans is the fast turnaround time in loan processing. Some tell you within 5 minutes, the money will be in your M-Pesa account or whichever digital service you're using for mobile money. 5-10 minutes, and you have it. So that fast turnaround time is actually a crowd puller. And many of us would agree that we don't want to apply for a loan if you need it like today is a Wednesday. If you want it perhaps by tomorrow to use it on Friday, you want something that's fast enough. Your average cycle bank institution perhaps take three to 4 working days. So this digital mobile or mobile money loan providers have actually cut that processing time, and it's one of the things that's resonating well with consumers. But this not, having stated this, what are some of the issues that have come to the fore with these mobile loans. Many a time, I think we've heard of mobile money lenders or digital credit providers for that matter, called their loan defaulters or the person who took a loan with threats, harassment and intimidation in trying to recover the loan. This actually goes against ethical practices for these firms. The other issue that many people have fallen into this trap of a vicious debt cycle, where you find an individual has more than 5 or even 10 mobile loan apps in their phone. On the screen, one of the screens is just mobile money lending apps. So you take one to pay the other to pay another to pay another. You end up just being in a vicious cycle of debt, which leads to desperation and, of course, stress. Of course, I've mentioned the reported threats, and some of the mobile lending apps have resorted to unorthodox ways of loan recovery. I mean, if I took a loan with Fiona as my digital lender, there's nowhere where I'm supposed to call my significant other to tell me I took a loan, or to call my brother or my parents for that matter, or my friends. So these unorthodox ways have actually been utilized by some of these mobile digital credit providers to try and recover their loans. And that goes against the data privacy issues, which is covered under Article 31 of the Constitution of Kenya. I'm sure this will be covered in the subsequent presentation. And one other thing that perhaps I think we also need to bring to light are the high interest rates and the short-term maturity period. You find that for a loan of perhaps, taking by way of example, if you take a loan from one of these apps of perhaps 5,000 Kenya shillings, then they deduct some amount. Let's take, for instance, 1,500. So you remain with 3,500 Kenya shillings. Within 2 weeks, you should be able to pay that 5,000, also plus an interest that will be charged within that period. So yes, they deduct firstly, so they give you net of the interest you're supposed to pay, and then when you pay, you pay plus an additional interest. So instead of paying that 5,000, perhaps you pay even 5,500 or maybe even 6,000. So it's even much more. It's almost like double the amount, almost like double the amount you had taken as a loan, which is actually it's a rip-off to the consumer. Right. So, what do we have as key takeaways from this presentation? Well, there's been an increase in usage and uptake of these digital credit providers. Of course, based and leveraged on technology developments, which means that your phones have become cheaper. They've been, so to speak, they've been democratized. So they're available all over the country. So anyone can purchase a phone, a smartphone, which in most instances are used for this kind of service provision. Again, to find that mobile money loans are, in many cases and many instances, a last resort. But the beauty of it that makes people glued and hooked to this, in my view, is that it's the access is quick and it gives you instant cash to sort out your whatever it is issue you want to be able to take care of. But thirdly, I think based on the fact that these providers have some resorted to unorthodox ways of trying to recover their loans, then we need to enhance consumer rights awareness so that whoever is taking a loan, you know that if I take a loan from XYZ digital lender, then in case of default, what are the channels that should be followed in trying to recover? What are your rights and what are your obligations insofar as that is concerned? Yeah, I hope I've been able to shed some light and give us the basic layer of where we are at, what's happening, and of course, I it back to Fiona. Thank you.
To start it off, allow me to reintroduce myself if those who had not had the opportunity. My name is Julo Kadia. I'm an advocate of the High Court of Kenya, currently a practicing advocate as such. Looking at the legal landscape in terms of digital lending in Kenya, and this is generally the discourse focus points given the 25 or 20 minutes that have been given to get to this. So we look at the legal framework governing digital lending. In this sense, we want to consider what are the constitutional provisions that touch on digital lending in Kenya. Secondly, we also want to interrogate the legislative provisions in the same. And then, of course, there are some regulations in terms of subsidiary legislation, which we will look at. And then afterward, we try and interrogate some of the rights of digital borrowers, some of the rights of the digital lenders, because in as much as we want to look at, or rather understand the rights of the digital borrowers, there is a corresponding responsibility on the part of the borrowers to also understand the rights of the lenders. So we will look at that as well. And then we will also come to the legal redress mechanisms. These are based on contractual terms. By all means, it is expected there will be some sense of friction, some sense of conflict. Earlier on, the speaker before me has mentioned something to do with debt recovery mechanisms which have been initiated or adopted by certain lenders, which may or may not be the proper procedure to be adopted. So we look at what are the legally allowed redress mechanisms. And of course, we'll try and discuss some policy gaps, which I think if we look at, then we may say that we have a digital lending regime which is headed in a proper direction. So allow me to get into the same. First off, to start it off is the constitutional provision. As you understand, the Constitution by dint of Article 2 and Article 3 declare that that is the supreme law of this particular, of this country, of this jurisdiction, and as such, we must start from the Constitution. The first thing that some of the articles, we touch on this, the others, but for purposes of our focused point, Article 31, the right to privacy. Now, this right to privacy includes that information which you deem is yours to remain with in terms of your financial position. So if you deem that that particular financial information that you have as regards your state is not one to be divulged, then it is yours to remain with. That right to privacy extends to not only property in the physical sense, but also the information concerning that individual. And further related to that is, of course, the rights in terms of access to information, which, although not directly linked to the same, will be in terms of the information that you give out there concerning yourself. You still have a right to access that information, correct that information, as well as that is also a concern under the Data Protection Act, which of course we'll get to later on. But that is as far as Article 31 is concerned. As far as Article 46 is concerned, which talks about consumer right to fair practices. Remember, the digital lending platform is still a service which is offered to the consumers. So consumer rights need to come in. How is it that I get to access? How is it that I get to address the grievances that I have in terms of this provider that is giving me this access to the loan that I'm requesting for? So consumer rights is important, and it's central for us to understand this. Because if you look at even what the Central Bank of Kenya regulates, the concern is the consumer, the borrower, to that extent. That is not to say that the lender does not have certain rights. They still have rights to that extent, but our concern for this particular point is to say that Article 46 ensures there's the consumer right. And remember, as I said, for each and every right that the consumer has, for each and every right that the borrower has, there is a corresponding responsibility on the part of that particular consumer, which translate to a right on the part of the lender. So Article 47 comes in terms of fair administrative action in two ways. One of the ways in which it comes in is in terms of the fair administrative action taken on account of the lender, because the lender as well is subjected to administrative action in the event that it is found to have violated certain provisions of the law, and as well as on the part of the consumer. So that in the event that the consumer feels that they have been aggrieved by the processes, the proceeding, they have a right to raise certain issues in the relevant platforms. Then, of course, we have the Ombudsman for maladministration. We shall see how that comes in at the point when we get to close in terms of recommendations and whatnot.
Julu, just
Yes.
a concern, your slides are not moving. So probably you can fix that.
No, I was still on constitutional provisions.
No, we are still on the very first slide on navigating. Yes, that's fine now. Probably you can put it in a show.
This, can you, is it now moving as it should?
Yes, it's in the second slide, but can you put it like as a slideshow, not as a PowerPoint?
I think that's what I'm doing as a slideshow. Does it still appear as a PowerPoint on your end or slideshow?
It's a PowerPoint.
Okay, perhaps just allow me to send it to you so that you can see how best to get to it. What I can say is that we were looking at the constitutional provisions in the sense that it is important for us to start from the constitutional provision because the Constitution of Kenya 2010 declares itself to be the supreme law in this particular country. And that's why we started off from those particular constitutional provisions. I did mention Article 31, Article 46, Article 47, and Article 59 in terms of the ombudsman for purposes of maladministration. And the next thing that I was to move to is on the key statute or legislation, also referred to as Acts of Parliament. The Acts of Parliament. To that extent, what this refers to is whatever Parliament comes up with, the laws that we understand them, is what we're going to look at. The first one is what is referred to as the Central Bank of Kenya Act. This particular act speaks to a good number of things, but I would just like to highlight some of them. And to this end, the first thing that I'd like to highlight is what is referred to as Section 33S of, yeah, I think it's now proper. Thank you, Fiona, for that. So Section 33S talks about the questions of licensing. For one to have a digital credit business, that is, you're in the business of lending for purposes of online platform or digital platform, you need licensing. And that's where Section 33S comes in. Simply put, Section 33 says that for one to conduct that kind of a business, you need to be licensed by Central Bank of Kenya. That places Central Bank of Kenya as a regulatory body when it comes to the digital access of loans in this country. The second one, which is directly related to what I've said, is Section 33R of the Central Bank of Kenya Act. Section 33R talks about the need for a digital credit provider to be regulated by the Central Bank of Kenya. So that, in other words, for you to actually get the licensing, for you to actually say that you are operating within a particular regime, that regime needs to be provided for by the Central Bank of Kenya. And then lastly, we have what is referred to as Section 57R, Section 57.3 of the Central Bank of Kenya Act, which of course, generally the section talks about the right, or rather the power by the Central Bank of Kenya to come up with regulations under that particular act. And one of them is what now we will look at later on, known as the Central Bank of Kenya Digital Credit Providers Regulations 2022. I take it that we are together up to that point. Right. Now, the regulations, there are several provisions of the same, but I'd just like to highlight some for purposes of our discussion so that it is clear how these regulations come to be. Remember, I've said that the regulations are anchored under the Central Bank of Kenya Act, given that that is the parent act. Now, the first regulation that I'd like to bring to your attention is regards Regulation 6. Regulation 6 speaks to what we identified under Article 46 in terms of consumer rights. Now, Regulation 6 refers to the idea that the information provided by this particular digital credit provider should be clear. It should be information which the rates will not be anticipated to change at the detriment of the consumer. In other words, at the point when you're getting into this particular arrangement, there is a duty, a responsibility on the part of the provider to inform you of everything that you're getting in a manner which is plain and simple to your end. Number 2 is Regulation 7. Regulation 7 talks about the interest rate and fee limits. There are certain charges which the digital credit providers come up with. Now, this kind of these charges that they come up with need to be understood in a manner which is not, again, detrimental to the consumer, to the extent that we do not have a ceiling. This Regulation 7 attempts to introduce a question of interest rate and fee limits. Thirdly, I will also like to rope in or to inform you about Regulation number 8, which Regulation number 8 talks about data protection and privacy. Remember as well, there has been a mention by my co-speaker and presenter, Mr. Dairo, said that there is a question of the use of the mobile phones, so that the data that we put out there by use of our mobile phones, by registration of certain access of mobile monies or access to credit to that extent, that data still find itself within the regime of the Data Protection Act, because that particular act speaks to everything to do with data in that particular country. So again, Regulation number 8 ropes in the provisions of the Data Protection Act in terms of consent for data collection and processing. Remember that the DCPs, that is the digital credit providers, are by themselves data processors to that extent. So the data that they have need to be subjected to the provisions of the Data Protection Act as well. We have what has been mentioned by my co-presenter as well as the questions to do with ethical recovery of debt. If we look at what is referred to as Regulation 9, debt collection must be conducted ethically, prohibiting harassment, intimidation. One of the things that we have in terms of the Constitution is the right to dignity under Article 28, which speaks to this ethical collection of debt. You need not be embarrassed by the DCP because you work in a particular environment and that particular employer is not really amused by your financial credits to that extent. So we want to avoid them because it is not one of the anticipated or contemplated means of collection or recovery of this debt. And that's why we have regulation number 9. The last regulation that perhaps I'd like to mention, as I said, the regulations are many, but just to highlight what the regulations give, I would like to go to finally what we refer to as the regulation number 11, which talks about consumer protection as the penultimate point in terms of the regulations. So regulation number 11 speaks to consumer protections because it talks about the unfair practices, including misleading advertisement. So that if you go online, either you're on YouTube or X or whatever platform, digital social media platform that you're on, and an advert comes in for a digital credit provider, to that extent, the information that you get from that particular advertisement must be true, must be plain, must be what is contemplated by both parties. Remember, it's a contrast still that you have on one part, you have the lender, and on the other part, you have the borrower. So to that extent, that regulation ensures that there is protection from unfair practices so that when it comes to things to do with representation of information, it is accurate. The last one, of course, which was part of the things which we had anticipated, is regulation number 13, which talks about complaint handling and redress. It provides for the mechanisms because, as I said, there might be some aspect of friction between the parties. People have not paid in good time. It's a source or an avenue for friction to that extent, and that's why we need the regulations to that extent because it provides for a redress mechanism to that extent. Having said that, I'd just like to highlight one or two case law on the next slide. The case law that I'd like to point out also speak to what I had indicated before. There was the case Digital Financial Services versus the CBK in 2022. That decision upheld CBK's authority, as we have seen under the Act. In other words, we also have judicial authority to that extent through case law, indicating that the Central Bank of Kenya has the authority to regulate that particular industry. The reason as to why this came about was because when we had the regulations, there was a bit of an acceptance by the sector in terms of that particular, the proposed regulation and the manner in which CBK wanted to come in and to regulate the sector. So that's why we have that particular case. But the long and short of that case is that CBK, the Central Bank of Kenya, has authority to regulate the sector. And then we also have Meruri versus Bank of Baroda, although not really related to digital credit, but the idea behind it is that when it comes to financial engagement and contract, unilateral term changes should not be accepted. It goes against consumer right to that extent. Having said that, I will move to the rights of the digital borrowers. In other words, this segment is just to give a summary from what I have indicated in the previous slide. So the first one, we can summarize the rights of the digital borrowers to be, number one, transparency and fairness, information access. When it comes to the information that you're being given, it is not just enough that you're told that we expect you to pay, let's say, 5% interest. It is also important that you be told what happens in the event that you do not pay. In other words, transparency of the information that you get. The full set of information is what the right of the digital borrower is when we look at transparency and fairness, even on the part of the lender. Remember, I mentioned that when we look at contractual issues, one of the key things that normally arises is in terms of representation of the information that you receive from the other party. So we don't want to appear that there was a case of misrepresentation on either side based on the information that was given. It needs to be transparent. It needs to be fair. Questions of fairness, just to finish up on that. We'll also look at questions as regard the timing when this information was given. It is not just enough that information was given, but we also want to look at the timing. Was it fair that I received this particular information 2 hours to when you want to either auction my goods or something restored. The timing as well is important. Okay. We move on to the second right, which is data privacy, text shaming, even consent in terms of who is to be called in the event that you're not around, so that we also have a way by which you can be tracked to also avoid scamming on the part of the lenders. But the key thing on the right of the digital borrower, that data privacy. Speak to what my co-presenter mentioned in terms of why is it that your significant other is being called? Why is it that your parents are being called, your siblings, your co-workers? That by itself should not be something that we should allow as either consumers of these particular services. Data privacy, remember I said that that particular data privacy goes to even the extent to your right to correct the information that is out there. So if you feel that the information that has been given is not accurate, it is not proper, then you have a right to correct that. Ethical debt collection. There are certain ways in which the law anticipates that you will collect your debt. And that is why we have the regulations, that is why we have the acts of parliament. In other words, again, remember Article 28 of the Constitution of Kenya, the right to dignity. It is okay, I have your debt, but the manner in which you go about seeking to collect it is also important. Remember, the question that we ask will be, what is it that you're interested in? Is it that you're interested in embarrassing that particular borrower, or you're interested in the recovery of your money? So that if we say that you're interested in the recovery of your money, then you have no business embarrassing or harassing that particular individual who sought to be a borrower from your facilities. And then we have the right to fair regulation, of course. As we saw, the rights of the consumers generally is to also have proper regulation. And in this case, we saw that CBK has the mandate to regulate the sector to that extent. And then we also have legal redress access. As a consumer, whenever you feel aggrieved, it is your right to ensure that this particular infringed right is there's redress to that extent. So you may file a matter before the courts with proper jurisdiction. You also have, you may lodge a complaint to the proper channels. If you go to the CBK Act, there are certain forms and manners which you can approach that. Legal redress, you can have it at the CBK, you can also have it at the Office of the Data Protection Commissioner and the Ombudsman. These offices are public offices. You can access their offices at any time for you to lodge your complaint. Then you also have questions of sensitization and education. One of the values and principles which we have adopted as a nation is questions of participation by the public. When it's come to participation by the public, the information need to be understood to the manner in which you can actually say that we participated because we understood what we are participating in, as opposed to coming in and informing people that this is what we require of you and we expect you to sign. And once you sign that, that's it. The information, sensitization and education is a right of the consumers to that extent. It's the right of the consumer to that extent, and it is important that people understand, or consumers understand, that they have a right to access that information and education before they make a decision, so that that decision is informative. As I close off on that particular aspect of sensitization, in contractual terms, it is normally taken that the person who drafted that particular contract, it will be interpreted against them because they were the drafter to that extent. So it comes in the same vein because it is taken that the drafter of that particular agreement, being in most sense the DCP, then it should be interpreted against them because they understand it more. If we have proper sensitization and education of the consumers, I believe that we will be asserting the rights of the borrowers to that extent. Let us move on to the rights of the lenders. The beauty of our constitution is that Article 40 talks about the right to property. Now, in the right to property talks about acquisition as well, not just holding it, but even the manner in which you acquire that particular property. When it comes to the digital lenders, we must acknowledge that particular right that they have. That is the right to access to property, the right to generation of wealth and property. When we have a DCP who is properly licensed and who adheres to the standards as indicated by CPK, as indicated by the regulations, then they have a right to operate to that extent. So that the first thing that a consumer must ask is whether that particular DCP has a license or not. Is that license valid or not? Okay. So it is a right of the digital lender who is properly licensed to operate. Number two, fair regulations. In as much as we say that CBK has the right to regulate, remember again, I said that Article 10 of the Constitution talks about public participation. Now, when you talk about public participation in the digital space, in the digital lending space or sector, one of the persons who should be consulted are the very lenders themselves. So that even if there is some sense of feeling by the consumers that our rights have been infringed, that addressing of the rights of the consumers need to be addressed in a manner which does not infringe on the rights of the digital lender himself. So that digital lender as well is supposed to enjoy the right to fair regulation, the right to reasonable regulation by the Central Bank of Kenya. Number three, we have commercial freedom. In other words, they are at liberty to dictate the terms again, as long as they are within the confines of the law. So that as a consumer, unless the lender open up that aspect of negotiation to the extent that you can vary certain terms, well and good. But that right as well remains with the lender. Commercial freedom. This commercial freedom has been tied to competition laws. In other words, as the players in the sector, they may not come up with a manner which will be disadvantageous to the consumers. In other words, coming up with a ceiling of a certain rate, which no one is below and no one is above, so that there are no options to the consumer. Early on, my presenter before me mentioned that you may have an individual who has different platform, different avenues of this digital lending. Part of the reason is because whatever A offers may not be what B offers. So you want to play about with what the market can offer so that you can have the maximum advantage as a consumer. Now, when we have that particular commercial freedom as a right of the digital lender, it must not be lost that the consumer as well still has a right to be protected from that aspect of unfair competition practices. And then we have loan recovery. It is a right of the digital lender. In as much as we're saying that they should be ethical, we are not saying that the digital lender has no right to recover that particular debt. Remember, it's a contract. And if contract or when contracts are violated, there's a breach of that particular contractual term, there is a right for you to seek redress in court. And that is why it is important for us to understand that the digital lender still has a right to recover. We may argue and debate about the means by which or the method by which they choose to go about that particular recovery, but the fundamental thing remains that they have a right to loan recovery. You cannot take someone's money and then just disappear. It is not right in our laws. You will be invited to the penal code provisions to that extent. But sticking to our topic of the day, the data use as well. If we come to the rights of the digital lender, remember, part of their business requires them to collect data. Part of the business requires them to process this data. So it is important for us to realize that it is a right of the digital lender to process the data with your consent, of course, because before they get to process that data, before they get to store or be the custodians of this particular data, they must seek consent from you. If you fail to give the consent, then the digital lender cannot proceed to that extent with your data processing. And as a last right to the digital lenders, I see that I'm almost out of time. Legal recourse. Again, just as much as the lender, the borrower rather, has a right to court, is the same way that the lender has a right to seek recourse in court. We will proceed to the next segment of our discussion, which talks about the legal redress mechanism, because as I've said, both the borrower and the lender have a right to seek legal redress. The first one is, of course, which I had mentioned, the borrowers have a right, or rather, one of the avenues in which they can seek redress is report unethical practices to the Central Bank of Kenya, of course, using the provided avenues. Data violations, you can proceed to the Office of the Data Protection Commissioner, Ombudsman, the courts, ADR. Now, sometimes whenever we have friction, a good number of us think that the best way is to go to court. But sometimes it may just be a question of discussion. It may be a question of negotiation, understanding. And ADR is important, especially now because it is enshrined in the Constitution, is an avenue that we can adopt. The courts acknowledge the same. In fact, the court may direct you to mediation or arbitration to that extent. And that is why it's important that as a lender, as a borrower, it is important not to escalate the issue sometimes. ADR, alternative dispute resolution to courts, is a form by which lenders and borrowers can improve the digital lending space that we have in this particular country, as opposed to each and every day having battles in court. Sometimes courts are not the best way, so that's why we have ADR. And then we have consumer advocacy and activism. As an example, in terms of activism, I think about 2 weeks ago, or in the last 2 weeks, although not directly related to digital lending, but to borrow from that particular instance, we had a lady who complained about Novita biscuit. Okay, as a consumer of that particular, and just show you how activism as well can be used to address some of these issues. And you saw the response by that particular uh, uh, manufacturer or provider of the biscuit, the response that they gave in terms of that particular consumer activism. So it is a right, it's an avenue which can be adopted, especially now in the wake of social media use. It's an avenue which can be adopted by borrowers, as long as, again, it is within the adherence of the law. We have things like defamation. We have the uh, unpopular version of the computer regime that we have, misuse and cyber crimes that we have. We also have, I mean, you have to look at those kind of things. The data that you process as well. The Office of the Data Protection Commissioner may as well be against the consumer or the borrower who addresses their issues in a particular manner. So as well, in as much as we may have some sense of activism, it is important that we adhere to the law as provided. Having said that, I will move on to the lenders. What are the avenues that the lenders can adopt when it comes to legal redress as well? One of them, of course, remember that unlike the borrower, we have the questions of administrative issues which come about. So the first one is you may have appeals where there's dispute of the regulatory decisions by the Central Bank of Kenya. The lender is as well in a position to appeal that particular decision. We have courts as well, is also open, uh, given the jurisdiction of the various courts, to sue the persons who default on payment. Of course, I've also spoken about ADR, which is also open to them. ADR requires both parties to attend. You cannot have the borrower only seeking to mediate. It also has to come from the point of the lender, so both of them. And in fact, if you recall our discussion earlier on the regulation, there is implied, or rather required, of the lender to have the dispute resolution mechanism within their own system, within their own procedures. So that as well, it is important that the lenders have that kind of aspect. And then, of course, last but not least, is what we have as the Digital Lenders Association, of Kenya, which as well might also seek to have activism to that extent, or even give certain directions, which they may have in the past. They have given certain codes, which we look at as we move along. But as far as some of the avenues are concerned, in terms of dispute resolution to the lenders, this is what may be available for consideration to that extent. As we come towards a close in the last segment of the session, I would like to move to what I may have observed as legal and policy gaps. Some of them, of course, are subject to be refined on account of what is happening currently in the sector. But let's just look at some of them. One of the things that we have is what may be taken to be fragmentation and over-regulation. We have different acts, as I pointed as examples, which look at this particular issue. In India, for example, they have unified guidelines for pricing and CRB reporting, which, unlike us, we may or may not have. To that extent. Nigeria has strict rules which cause a slow growth. In the Kenyan position, there has been some sense of steps, but not yet to the extent that one would like to see. And of course, if we try to balance between the examples that I've given in terms of India and Nigeria, we may come to an understanding which is workable for the country. But currently, we have fragmentation and over-regulation in our laws. Secondly, we have credit reporting. In some of these digital lending platforms, you may have an amount which may be below 1,000 Kenya shillings. If we look at CRB rules, any debt below the last time I checked, any debt below 1,000 Kenya shillings is not qualified to be reported to that extent. So what happens to a situation where we have a borrower who took less than that particular amount which has been indicated as a threshold? And that is why I'm indicating that the credit reporting system is a bit ambiguous to that extent. We need some sense of clarity to that extent. Interest rates, the regulations speak to adherence to certain limits as indicated, but there's no particular cap to that extent, which risks predatory practices. And then weak consumer education or sensitization programs or platforms. Of course, we do have the likes of the Kenya Consumers Protection Advisory Committee, which may look into those kind of things. But it is important that we have more and more, especially now in the wake of access to information being easy on digital platforms. We should have more and more in terms of the consumer education and sensitization. Data privacy issues, self-regularization. If you look at what I mentioned as the Digital Lenders Association of Kenya code, it's not per se binding in terms of our laws to that extent. So you may want to find a way in which we may bring this code to have some sense of force. And cross-border issues. For example, what happens in the event that you access digital credit lending outside the country? To that extent, if you look at questions to do with the Data Protection Act, there's a bit of limitation in terms of data which is processed outside the country. So how do we marry these two? These are some of the things which perhaps moving forward we should look at some of the gaps to that extent. Recommendations, picking up from those particular gaps, enact unified legislation. The CRB reporting need to be looked into, and then of course make the code binding as I've indicated to that extent. More or less this recommendation just pick up from the gaps as identified to that end, and as was mentioned by the host, IEA, this particular write-up will be up and for purposes of reference. Deductive points as I come to the conclusion of my presentation is that we do have a proper system or framework, although it is fragmented. There has been, if you look at pre-2020, there has been some sense of a step in the positive direction by coming up with regulations, by coming up with the amendment to the CBK Act, all this just to ensure that we have proper systems when it comes to digital credit access to that extent. And then we also need to have the borrowers verify the licenses, report violations, seek to do that within the law, and also for the lenders ensure compliance, join the Digital Lenders Association of Kenya just for proper regularization and also for purposes of feedback and also to that extent. As I conclude, for the policymakers just to ensure that that particular act, maybe it's enacted to that extent to promote consumer sensitization and education, as I believe that was the intention by the Institute of Economic Affairs having this platform today. Thank you very much for listening to me. I look forward to further engagement.
If anyone has a question, I'll read the ones on the chat box, but if you have a question, you can raise your hand and then I guess the mics are, no, the mics are not yet up. Yes, now they are. So if you have a question, just raise your hand and then I'll be able to see you. But there's a question from Jairus on why would some DCPs be allowed to operate before they comply with requirements for registration. I think this is a question for Steve because he had talked about this. But Julu, in case you have a comment on it, you can go ahead and answer. And there's also another question. Most of the DCPs have mobile apps which require access to almost every information on the gadgets of the borrowers. Does the ODPC have a say on what amount of data DPCs can collect, and are users allowed to opt out and have their data deleted? Oh, that's an interesting one. So I'll ask the third one, and then I will ask Steve to go first, then Julu, and then I'll come back to, I can see a hand from Moses. So the third one from John Mutua is specifically to Julu. I may have missed it, but I do not think that I have mention of Competition Authority of Kenya and their role in enforcing consumer protection provisions. Is there an avenue for a consumer to seek redress in case of aggrievement? So probably we can start with those three. Steve, you can go ahead, and then Julu will come next.
So in terms of this first question, why disputes would be allowed to operate before they comply, I was looking at a case that was placed within the small claims court by one of the digital credit providers, and just some in the early this year. And what the court found out that in as much as this credit provider was operating, and they had filed some interesting cases of defaulters with the courts, seeking that, of course, the courts compel the defaulters to pay back the lender. The courts found out that this particular lender had been operating, but they were saying they're within the pipelines of compliance. So that I think is a gray area which allows then this kind of digital credit providers to continue being in business, regardless of whether they've attained the certification or not, because it is said they are in the pipelines of compliance. If I remember what that particular small claims court actually issued as a directive. So being the case, then this particular provider was actually found not to be operating within the proper legal framework, and then that also meant that, of course, their challenge for that claim or for that debt payment was also quashed by the courts. So yeah, I think they operate within that particular framework, that they are still trying to. They are in the pipelines of compliance, and they are in the en route to complying with the laws that have been placed for such providers. Yeah, that's all I can say for that. Thank you.
Okay, thank you, Steve. Julie, you can go ahead.
Yeah, perhaps looking at the questions from the chat, I did mention a certain aspect of the competition authority, as I mentioned, uh, although not in
Julie,
details,
can you
given the
hear
time
me?
constant. Sorry? Sorry? May I continue?
We can't hear you.
Yes, please. We can hear you.
No, I'm asking Julie if you can hear me.
Yes, I heard you, and I was addressing the comment. May I proceed?
Yes, please.
All right. What I was getting at is in terms of the questions which have been raised. The first one, talking about registration, there was a directive that all DCPs should have been registered and licensed by the 17th of September 2022. If you look at the Central Bank of Kenya directive to that extent, that speaks to the questions of licensing. As far as the decision from the small claims court is concerned, I'm yet to interrogate the same. That might have escaped my mind, but I will look into it. But having heard from what my co-presenter mentioned, I would not be inclined to adopt that particular decision to that extent from where I'm seated, given that a license is deemed to have been processed the moment when it is issued. So an application to a license by itself is not the issuance of a license. And that will be my comment to that extent. The last one is as regards the competition authority. I mentioned that the questions of the competition regime comes in. For example, let me give you one. If you have one of these large entities, they cannot come in and dictate the price just because of their dominance in the sector. That is a question of competition, which I believe section 22 or 23 thereabout of the Competition Act should be addressing that question of dominance in the market. Again, you have penalties which may be imposed on the competition authority in the event that there might be violations to that extent. Or you have what I had mentioned earlier, Mr. Mtua, if you did not get the opportunity, I had earlier mentioned as well that we may have also questions of where there is some sense of collusion by the providers, that we decide that as providers or players in the industry, we are not going to go below this and we're not going to go above that, so that everybody is at, let's say, 1%, so that there's no competition per se, there's no variation for the consumer to that extent. So these are some of ways in which the competition regime as well comes in to protect the consumers when it comes to digital credit provision. Of course, like I said, Mr. Mtua, given the time constraints, and as you can see that it's a topic which we cannot really conclude in a year's time, but given the gradual development of that particular regime, but I believe that through the Institute of Economic Affairs, we can open that discussion further. But just to put it simply, that the Competition Authority of Kenya is as much an important player in this particular industry as any other player in the industry. Thank you.
Thank you. We had a hand from Moses, but I hope Jairus, John have been answered. Moses, you can go ahead.
All right. Can you hear me?
Yes.
Okay. I have two questions. Steve, you said that in digital lending, there's a likelihood of having, to quote you, rip off interest to consumers based on assessment of risk, which would probably used to determine the interest rate. Given that fact, and probably is this a claim that the interest rate is not market determined and it's set in a way to exploit? And what what do you think is the redress to that, bearing in mind that over-regulation on the same might mean that the lending will not be available to the consumers? And then to Julu, some of the mechanism used to recover these loans, including probably what has been reported in the country, the lenders calling the family, are sometimes claimed to be contained in their terms of reference. And therefore, people tend to accept to the terms, whether with their knowledge or not. Does the law give direction on such kind of terms? Thank you.
Okay, thank you, Moses. I can't see another hand, so probably, Julie, you can address the question that has been directed to you, and then Steve will go next.
Right. The question as regards whether the consumer, that is the borrower at this particular point, is at liberty to decline to accept those particular starting terms, but yet access that particular credit facility. I think that's the gist of the question, if I got it proper. Now, where you have, remember I said that this thing is contractual. You have the borrower on one end and you have the lender on one end. So that particular engagement commences off from the point of contract, that I'm willing to offer this and I'm willing to take up whatever you're offering. I also mentioned that in terms, one of the principles of contract law, contra proferentum, is a term or a principle which is used in the sense that we will interpret that particular contract against the drafter of that contract. In this sense, in the example that Mr. Mushiri has given, Mr. Mushiri Mwangi has mentioned that you have the terms which have been given to you by the borrower, by the lender. Now, in this sense, those terms, as you rightly pointed out, have been given by the lender. Now, in the event that you find that there are certain violations, remember that you cannot enforce a contract which has been taken to be illegal. One of the fundamental things that you must look at into a contract before you enforce it is the legality of that contract. Now, if we look at the jurisdiction that we have in our country, is there any violations that may come up legally when we have a clause, as you have pointed out? And this is why we have in this particular discussion, to the extent that the consumer need to understand that the mere fact that you have certain things which have been indicated, we must interrogate those particular things, so that is it a question where the lender is presenting a false facility being offered to the consumer? In the event that we find that this particular provision violates data protection, violates competition regime, violates the CBK financial regulations, any regulations which is off, that contract by itself, that term by itself is not supposed to be enforced, because a contract by itself need to be legal. The legality of that contract first need to be established. So if a clause violates the right to privacy, then we should not proceed with that particular contract. So the consumer as well, remember I said that the consumer has certain avenues to address these issues. You may go to court to address that particular question. You may write to CBK to address that particular issue. You may write to the competition authority to complain on that particular issue. So I believe I will leave it at that, Mr. Mushiri Mwangi, if you may allow me.
Thank you, Julie. Steve, you can go ahead.
Okay. I think the gist of the question that Mr. Moses was asking was actually on interest rates for these digital providers. Now, for those within the market, each and every lender have their own mechanism determining the interest rate for the loan that you seek to have. In my thinking, this I think is mostly based on the kind of market we have. It's a competitive one, it's free and open, and those sources of demand and supply actually, I think, come into play to dictate the kind of interest rate that a particular provider would place on an amount or a service they provide. And on this point, I think one of the things as a way forward that my co-presenter mentioned was something touching on those interest rates. I'm not certain that that should be the way to go. In my view, because we are operating in a competitive economy or a competitive market for that matter, perhaps we should just let the forces of demand and supply and the nature of competition within that particular market sector come into play. That's what I would say for now. Thank you.
Okay, thank you, Steve. At this point, I don't see any other hand raised, so I'd invite both our speakers just to give their closing remarks, and then I'll do the vote of thanks, and we can close there. So, Steve, you can begin, and then Julu will go next.
Yeah. Well, I think the area in which we are speaking today is the mobile money lending apps, or so-called digital service providers, are here to stay. It's the manner in which we embrace the usage of the various options that are available to us that matters. And also need to be aware of the various redress mechanisms that are at play, specifically when it comes to the loan repayment and loan recouping by these providers. That notwithstanding, I think the onus is on us as consumers to actually go through the terms and conditions, which I highly doubt if we do. Personally, sometimes I don't. And to see what actually these terms and conditions are, so that you are in the know whenever you are faced with such circumstances that may arise from these providers, then you know how to go about them. Thanks a lot, and have a lovely afternoon.
Thanks, Steve. Julu, please go ahead.
Yeah, I would like to say that one of the things that we must realize is that the digital lending platforms is based on a progressive information system, technology aspect. So whatever we discuss today, we must also have in mind that we should have the next 50 years or 20 years, so that when we come to regulation, it is something which is serving us today. It is something which will serve us in the future. We have seen the past where we're coming from, and as I've said, we've made progress from 2020 all the way up to now 2025, when we have the regulation, the first generation of the regulations. Let us now move on to the second generation of the regulations. With having everybody come on board, the more discussion that we have, I'm sure that we will refine these issues, because as has been said, digital credit lending is here to stay given technological advancement. Thank you very much.
Thank you. Yeah, so at this point, I just want to thank the ERCP team for convening this webinar, and just to thank every one of you for joining us today. We've been together from 11, so we don't take it for granted that you took your time to attend this webinar. Thank you so much for our speakers, Mr. Stephen Jairo and Mr. Julu Okadia, for your time and also for your insights during the presentations. Personally, I've learned a lot, and I'm sure the other participants as well have something to take home. And so thank you for that. And I also want to thank, for those of us on this side, our technical team and also our communication team for just publicizing this webinar today. And I hope that from today's discussion, we can be able to just reflect and continue to have this conversation going. So just to inform you as well, tomorrow we have another webinar that's being hosted by our Constitution, Law and Economy program. So it's on the public policy lessons from Owino Uhuru Supreme Court decision. It will be at the same time from 11 to 12:30. So if you have some time, kindly just log in and listen to what they have for us tomorrow. And the IEA is also a membership institution. If you'd like to be a member, you can reach out to our communication team. I'm sure if you even send like a direct message on Twitter, they will be able to respond and to assist you on how you can become a member. So with that, I'd just like to say thank you again, and we look forward to engaging with you tomorrow and any other future webinar that we will have. Asanteni sana. Have a good day.